Hi, and welcome to the monthly webinar hosted by Ambit Asset Management. And today, presentation is broadly going to cover three aspects. A, going to be our returns. B, the theme of the month, and then we'll get into the macro part of it. If you look at the portfolio performance for the month, suffice to say that across the board, all the Ambit portfolios are firing on all cylinders. Ambit Coffee Can delivered a return of 3.5% this month. The 1 year return now stands at closer to 23%, and the since inception return stands at closer to 17.1%, almost a 300 basis points outperformance over the Nifty 50 TRI. When you look at the good and clean mid cap portfolio, 3% return for the month and almost 21% return in the last 12 months time frame, and 13.1% return on a since inception basis, almost 120 basis points kind of outperformance as compared to the BSE 500 TRI. If you look at the emerging giants, 5.2% return this month, and over a 12-month time frame, closer to 41% returns, and Ambit 10x delivering 3.2% return this month and almost 34% return on a 12-month basis. So suffice to say that quality has come back into the play. The Ambit portfolios are all firing on all cylinders at this moment. This month's theme, we thought we'll capture the retail industry, its evolution, the impact, and the broader trends that have happened around us. Suffice to say, some very interesting reads that we are going to see. Now, if you look at the India retail industry at almost $800 billion, is one of the most nascent ones in the world as compared to something like a US. And when you adjust it for the population base that we have, I think suffice to say that there is going to be a large leg up of growth that is still left, while the global retail industry is expected to grow at 3 to 4% levels. We are expected to grow at close to 9 to 10% levels. And in the course of last 30 odd years, we've seen a significant amount of evolution, from traditional retails to the emergence of organized retail to modern trade to e-commerce and now omni-channel retail, which has happened. We've come a very, very long way. And like I said, we are expecting the industry growth to sustain at 9 to 10% levels over the course of next 10 to 12 years, 15 years. One is obviously disposable incomes that are going to increase. That is going to be one big lever to it. Second is that the population composition, right, which is comprised of largely millennial people, evolving consumer attitude people. We are now seeing a revolution as far as the access to finance and ease of consumer credit is concerned. The whole K-shaped recovery that we keep talking about, the shift, the formalization in the economy from unorganized to organized, are all going to push the industry towards a $2 trillion mark by 2032. And some of the major themes that are emerging out and how our portfolio companies are playing towards this. One is the shift which has happened from unorganized to organized. One company that stands out in this regard and has kind of benefited immensely is Safari. Second is, if you look at the play on premiumization in India, then again, one company that stands out over there, which is Relaxo, Bata versus Metro, the trend is very, very clearly visible over there. When you look at the omni-channel strategy, Titan stands out in that respect. And when you're talking about very, very rapid, urbanization, Trent is again something that kind of stands out and, is clearly visible in terms of the growth that is visible over there. Quickly shifting on to the macro, the Indian economy remains on a very, very strong footing. We continue to see the economic growth remaining very, very strong. GDP growth rate is very strong. The GFCF continues to remain very, very strong at around 15%. The Indian economy has grown 7x from 2002 to 2022, and we've gone from about 0.5 trillion to closer to 3.5 trillion, right? So that's the kind of leap that we have taken. Now, manufacturing, obviously, and services continue to remain very strong when you look at the domestic activity, which is comprised of the unemployment data, the power, mobility, rail freight, real GST collections, and manufacturing services, all inclusive, continues to rise and remain very, very strong. And surprise, valuations are also very uh, so we continue to remain very constructive on the market. We continue to remain very bullish on the market. The ROEs are very healthy. The valuations are inexpensive, and the markets continue to remain on a very strong footing. And hence, the right time to invest in equities is right now. Thank you so much for joining us today.